Well, the cost of living, interest rates and the official cash rate are all obviously on people's minds at the moment. So how can Kiwis deal with these increases to adapt and deal with the property market? Here to tell us more is our Property Apprentice founder and CFO, Debbie Roberts. Debbie, good morning.
Good morning.
All right, so what should we be doing if we are looking to get into the property market? We're seeing everything go up. You know, most economists predicting the OCR, for example, will peak at 3 to 3.5 by 2024. What should we do to plan for this stuff?
Yeah, a lot of economists have actually predicted that now it's going to increase to that peak earlier than 2024. Like some of the economists over the last couple of days have come out and said that we could reach that peak before the end of this year. So, you know, that's a bit horrifying when you see how quickly interest rates are increasing. Now, something interesting to note is that the interest rate in savings accounts don't seem to be increasing at the same rate as mortgage interest rates. So I think the people that will get hit hardest by this will be the people who already have a mortgage that's coming up for renewal over the next 12 months, because they will have got used to paying their mortgage at a lower interest rate, and so it'll be quite a shock to come off a 2% or 2.5% interest rate and having to refix at 5.5% to 6%.
Yeah, absolutely. So people in that position should obviously get some advice about how to go about doing that.
Yeah, absolutely. And there's lots of things that a mortgage advisor can help you with, you know. So talk to an independent mortgage advisor, because they can help you work out if you've got savings, for example, then you might be able to have an offset account to help you pay off your mortgage faster before the interest rates increase. It might be worth your while to break your interest rate that you've got and refix for a longer period, albeit at a higher interest rate, but it might actually still work in your favour. So, you know, mortgage advisors can crunch all those numbers for you and give you some really good guidance. I think something else that's really worth considering is, instead of having your entire mortgage on one fixed interest rate, you can split it up to spread your risk, you know, so have part of it expiring in 12 months, part of it expiring in 2 years, another part expiring in 3 years, just for example. Okay, so your mortgage advisor can look at your overall position and discuss all of those different options with you and find one that suits you best. I mean, at the end of the day, most people will cut back on their spending in order to continue to pay their mortgage. Yeah. You know, that's human. That we all need a roof over our heads, right? But with the inflation the way that it is going to be tough for a lot of people. So, you know, talk to your mortgage advisor sooner rather than later. Don't leave it until you're struggling to pay your mortgage. Get on top of it sooner rather than later, because potentially you might even be able to switch to an interest-only mortgage for a period of time.
Yeah, it's interesting.
Things are really tough.
Yeah, it's interesting you talking about, you know, because it does seem like a drastic measure to pay the fee and get out and pay it off, and then, you know, it does sound like a drastic move. But as you say, in the long run, it could actually be cheaper for you. Debbie, thank you so much for joining us this morning. We really appreciate it, as always. Property Apprentice founder and CFO, Debbie Roberts. Thanks to our partners, Property Apprentice